Good morning, everybody, and thanks for coming along to our webinar this morning on pensions. For those of you who don't know me, my name is Jonathan Sheehan, and I'm the Managing Director of Compass Private Wealth. I'm also deeply passionate about pensions, and we're coming up to my favorite time of the year, which is pension season, hence the timing of this webinar. In terms of housekeeping, there is a Q&A tab. So please do pose questions to me as we go. None of the other attendees can see your questions. So put the questions to me and I'll endeavor to answer them during the webinar or at the end of the webinar. This webinar is being recorded. You guys as attendees aren't being recorded, but we will put it up on our website afterwards, and slides will be also made available to you afterwards. And later today, we'll send you a short online feedback form just to get your feedback on how we can improve these webinars going forward. So today's webinar is the 8th of 10 webinars we committed to for 2021, and covering off 10 distinct yet interrelated areas of personal financial planning. All of the previous webinar recordings are available on our website in the Insight section. And we also have slides available upon request. So if you have some time, do peruse into the different areas when you have a chance. So starting off, financial planning for retirement is our first section. So rather than going into the textbook definitions of what a pension is and a tax relief, really, I want to talk about the purpose of pensions and why do we need to save for a pension, or if you're in retirement or transitioning to retirement, what has been the purpose of it for you? Well, the first is to fund your essential living costs in retirement. So the state pension in its own right isn't enough for a lot of people. So a pension is to firstly meet the bread and butter needs that you have. The next level up from that is to enjoy your retirement, which is your leisure spending in retirement. So you want to be able to have a cup of coffee and enjoy it, play around a golf or go on holidays. And thirdly, to the extent that there's capital left over, it's to actually pass any assets on to the next generation. This is just a quote, and it's about being able to enjoy a nice lunch and not feel guilty about it. When we talk about the word retirement, let's try to replace that for the next 40 minutes or so with financial freedom. So because a lot of people who are very successful in their careers feel as though, God, I'd never retire because what would I do with my spare time? And a lot of the time, actually, as people get older and into their late 50s and 60s and 70s, their income actually continues to increase because they've built up a wealth of intellectual capital or contacts or a bigger business. And the idea of retiring doesn't sit well with them. But getting to a point of financial freedom where you hit a particular point where you say, I actually don't need to work anymore. I may choose to work because I like working and I like the challenge that brings, but I don't actually need to work. And that's what financial freedom is all about. 3 phases of retirement. So in the 1 to 5 years pre-target financial freedom date is very, very important to start getting your ducks in a row and start planning. So with the best of intentions, a 40-year-old like me, who is in my head 20 plus years away from ever getting to financial freedom or retiring, it's not really a tangible plan that I have that anybody kind of below the age of 50 has in terms of planning for retirement, because it's so far off in the future. Yes, they can be putting money into a pension to fund future retirement, but it's really only in the 1 to 5 years before retirement that people start actually planning and thinking about numbers. Then you've got that transitionary period, which is the 12 months before you finish your employment or your self-employment, and the 12 months afterwards, which is very challenging from a behavioral point of view. We had a webinar back in, I can't remember if it was January or February, but with a guy, Brian Mooney, who's doing work with Standard Life, and he kindly spoke in our webinar, and that's available on our website in the Insight section. And that talks more about the lifestyle and the psychological aspects of moving from working X amount of hours per week to not working at all. And that's a very important time from a financial point of view also. And then there's being in the retirement years. So now you have your ARF pension fund or whatever it might be, and you're enjoying your retirement, or hopefully enjoying your retirement, but you need to make sure that your financial assets through your pensions and your ARFs or whatever it might be are working for you and producing the necessary amount of income for you. And also that you have a robust financial plan so that you're not spending too much money or you're not underspending either. Key principles with pensions is maximize your pension contributions if possible. Be flexible on your retirement age. So sometimes we have to have hard conversations with clients to say that you have told me you want to retire at 60, but the plan we've done isn't commensurate with that. So unfortunately, sometimes you need to potentially push back the retirement age, and I'll show you why in a minute. And also have a cash flow and capital plan, which is essentially is a holistic financial plan, which is something that we do for our clients. Okay, so this chart is hopefully quite insightful in illustrating the proportion of our lives that are spent in retirement now versus in previous generations. So if we assume most people start working properly at 25, retire at 65, you're working for 40 years. Now, previously, you may only have 15 years at the other end because people lived till 80. That was a good age, as they'd say. Whereas now, thankfully, we're all living a lot longer. So finishing at 65 or 63 or 64, you need to be prepared that you may have 35, 20, 25, 30, 35 years in retirement to fund. So it does mean sometimes you need to push back the retirement age, but it also means that if you take our advice and maximize your pension as much as possible in your working years, actually you may be able to afford to retire earlier and have a longer twilight years in retirement. So what does retirement mean financially? Simply means that your earned income ceases. A lot of the time your life cover will cease. So you may need to replace that in retirement if there's a need for life insurance. Other sources of income then will kick in. So your ARF income, your state pension income will kick in currently at 66. And the profile of your outgoings will also change. So some people, the debt and mortgage repayments will cease completely. But actually in retirement, you have more time in your hands, and people tend to spend a lot more when they're in retirement. And also it depends on the profile of the person. Some people love traveling, some people have health issues, and healthcare costs form a higher portion of their outgoings. It's really about having a tailored plan for yourself and understanding what your outgoings will be in retirement. So ultimately, cash flow surplus may turn into a cash flow deficit in retirement. But remember, there's nothing wrong with that if you have sufficient capital built up. So that's where the cash flow versus capital plan comes in. Okay, so building a capital sum for income in retirement. So capital sum for income includes all of your pensions and your spouse, if you're married, all of your combined pensions, but also all of your other assets as well, including your personal cash and your personal investments and the value of your business and all that type of thing. What I do suggest is that you exclude the value of your home on the assumption that you've no plans to move house. So just the way property prices have gone in Ireland is that if you include the value of your home, it can actually flatter your financial position too much because there's nothing you can do with it. A property is actually a cost center. It costs about 30, 35 grand a year to run a lot of homes, depending on how many mouths there are to feed. So just exclude that. And also ring fence a small emergency fund for old age, healthcare, or maybe some people say, look, I want to give each of my kids X amount as a gift. And if that amount comes to 300 grand, maybe just ring fence that separately. Building a retirement fund. So how to calculate it in advance of retirement is you calculate your cash flow surplus. You multiply that by the years to retirement. So if that's 10 years, whatever it is, you add on the current value of your assets. You add in the assumed asset growth. At the moment, the asset growth rate for cash is 0 and potentially negative. So, and the average growth rate assumed for investments like equities or property, you have to look at about 4%, I think is the most realistic in the current climate because we're in a low interest rate environment. And that'll give you a future capital sum value at retirement. So for example, someone is 55 and they say, okay, 10 years to retirement, I'm running a 40 grand a year surplus at the moment. That's 400 grand extra over the next 10 years. And I'll add that into my current assets, assume a rate of growth, and therefore at 65, I'm going to target, or we as a couple will target a capital sum of X. Take away your nest egg amount, and remember that'll change on an annual basis as well. So as needs change, that amount will change as you go. Also deduct the value of your home, and you've got your capital sum for your income. What income does that give you? Well, ultimately, I would divide it by 20. It also depends on the number of years in retirement. So the younger you retire, the bigger your capital pot is. So if someone retires at 60, they're going to need a bigger pot than if they retire at 70 or 75. So multiply by 20. So, you know, at 3 million total value, just divide that by 20, 150 grand a year gross income. Compass Private Wealth don't advise on tax. We work with tax advisors and accountants. We are complement their services. So always go back to your accountant, your tax advisor to understand exactly what your net income will be. There are a couple of online calculators you can use, but you know, for a retired couple with their only source of income being pension income or investment income, the amount of net income after tax they receive is usually a lot higher than they think, because people think, oh, I pay tax at 52%. But remember, there's no employee PRSI after age 66 at the moment. So that's a 4% saving. And between standard rate cutoff and joint tax credits, people are generally pleasantly surprised at how much net income they receive from gross income in retirement. So how do you avoid running out of money in retirement? And how do you make sure you enjoy your retirement? Do maximize your contributions while working. We have some accountants and tax advisors on this call as well. I'm sure you're blue in the face with me always reminding you to remind your clients to set up pensions and maximize contributions. It's so important. Sometimes you have to consider delaying retirement. And you need to make sure that your spending in retirement is appropriate. So a lot of people come to us and they think that we're going to be telling them, oh, you need to stop spending and don't be going on big holidays and don't buy a new car and don't be giving money to your kids too much. But actually, sometimes people are pleasantly surprised when you look at the other way and say, actually, I can, or we can afford to give more money to our kids. We can afford to spend X on a new car. We can afford to generally have more of a lifestyle budget, because they're surprised at how much of a pension fund that they've built up in their working years. And the only way to do that is by doing a holistic financial review. So what affects the future retirement fund value? Well, the current value of your assets, that's your starting point. The years to retirement. So the more years there are to retirement, the more of an opportunity you have to build a capital base. What your cash flow surplus is, so the amount you're earning in income in retirement versus what's going out, and the annual return on all of your assets. So some people have enjoyed positive growth in the value of property and equities over the last few years because we've had a conducive environment. You have to forget about the past. Don't get caught up in recency bias. I'm not being negative here. Obviously, we manage significant amounts of capital for our clients. And I will always remind clients that you have to look at the historic rate of return on assets relative to the risk-free rate of return, which at the moment is 0. So anything in low risk assets at the moment is earning 0 or negative. Deposit rates have gone negative, over 1 million with AIB and Bank of Ireland. Pensions in cash are always earning negative, and government bonds are earning a negative yield, in particular if they're thrown into an investment portfolio with high fees. So if you use the blended zero rate on low risk assets with the 4 to maybe 5% expected return on higher risk assets, you might actually be at a blended rate of about 3%. So that needs to be a bit of an expectation at the moment in the low interest rate environment. Retiring is about pivoting from earned income into passive income. Your earned income ceases in retirement. That's what retirement is. But passive income is there to replace it. And how do you replace it with passive income? You build up a capital sum, which is exactly what we've been speaking about in the last few slides. Thankfully, our government do incentivize us to put money into a pension by giving a 2 million threshold in terms of the capital value, giving tax relief on contributions, which I'll speak about in a minute, tax-free growth, and also tax-efficient drawdown in retirement. So pre-retirement, there's 3 stages. The first is pre-retirement. You're ultimately making sure you have the target retirement age and you're maximizing your contributions. You're transitioning to retirement. You're making sure that in the year either side of retirement that you've done all the calculations to make sure that your money is appropriately invested and diversified and you have all the assets in the right structures. And then in retirement, you want to continuously update your cash flow versus capital and make sure that you have a succession plan for the next generation. So that's generally what we spoke about so far. It tends to be the more exciting or interesting side of it because it tends to excite people thinking about putting a long-term plan in place. The boring part is talking about the actual pension products that populate a retirement plan. So I'm going to try and make it as exciting and interesting as possible by using bullet points. So 75 is the latest age a pre-retirement pension can stay in a pre-retirement structure. So at 75, you get kicked out and you have to retire it. And a PRSA can go up to 75. So sometimes it suits people to keep a portion of their pensions in a pre-retirement structure until 75. 50 is the earliest you can get access to an old occupational pension scheme through a buyout bond. 55 is the same for a buyout bond, but a QROPS buyout bond, if you've taken it back from the UK, you can get access to it from age 55. Always remember that your employment retirement age doesn't match your pension retirement age. So they're not actually the same thing. So you can retire from work and decide not to retire your pension. And sometimes you can retire your pension and not retire from work. The exception to that is if you were a public service or a civil servant, you had 40-year service, you retire at 65 and your lump sum and your annuity kicks in. But for those in the defined contribution, private sector world, those two things don't have to match. And also, ironically, the more different pension accounts you have, the more flexibility that gives you in retirement. And we'll talk about that in one of our case studies at the end. So 25% is the lump sum entitlement when retiring a pension. So 25% can come out in a lump sum. Of that 25%, the first 200K is tax-free. Next 300,000 is taxed at 20%. If I have time at the end, I'll show you our new website as well, which I'm very proud of, but we have a full content library and pensions is one of the areas, and we actually have all of these rules in the content library section of our website. And the AMRF, and sorry for all the acronyms, but an AMRF is the first 63,500 of your 75% after retiring a pension must go into an AMRF pension. That's locked away until 75. The ARF is what remains after the AMRF is taken out, approved retirement fund. And the 4% is the minimum distribution you must take out of an ARF once it's in place. once you reach 61. This goes to 5% from 71, and it's actually 6% if the total value of your ARFs are more than 2 million. Okay, so pensions and tax. So ultimately, pensions are very much about tax, about tax relief. So the first thing is that there's tax relief going into a pension. So the company gets relief from corporation tax on contributions. The individual, the member, or the employee, or if you're a proprietary director, you can have two hats on. You can be the company, the employer, and you can be the employee member. So from an employee's perspective, you get 40% tax relief on personal contributions and ABCs, and you actually get 52% tax relief on what the company puts in on your behalf, because that's exempt from 4% PRSI and 8% USC. There's also no employer PRSI and pension contributions. Employer PRSI is now 11.05%. That's a very, very big saving. So once the funds are within a pension structure, regardless of what type of pension it is, it can grow to 2 million tax efficiently. The funds grow tax-free within a pension. So what that means is that there's no capital gains tax, there's no income tax on dividends or rents for property or whatever it might be. And actually, I won't go into in detail here, but the actual tax efficient pension fund value is 2.15 million rather than 2 million, because there's an offset on the chargeable excess tax versus the lump sum. But I won't go into it here, but do contact us if you want more details on that. Then when you're taking money out of a pension, you get 25% in lump sum, the first 200, which is tax-free. Of the 75%, 63,500 is ring fence until 75, or when you're in receipt of the full state pension, which at the moment is 66 or 67 or 68 in due course. So that 63,500 isn't subject to the imputed distribution until it turns into an ARF. And then on death, the ARF and the AMRF, they don't get taxed on the death. If you're married, they just go into the spouse's name. And so it continues on until the second death, which is tax efficient, obviously, if you're deferring capital taxes. And on the death of the second spouse, if there's children, they will get taxed at a flat 30% rate, which is lower than the 33% inheritance tax. That 30% is nothing to do with inheritance tax, so you don't avail of the thresholds, but the hope is that the thresholds will be capped out through the principal private residence or other assets that the couple might have. And generally, the rate of income tax on the 4% or 5% imputed distribution will be a lot less than 52%, because you won't have 4% PRSI, and you'll have a higher standard rate cutoff. Your tax credits will be assigned to the ARF provider, the QFM it's called. So most of the income from an ARF is generally tax-free. If we were to compare two portfolios, one being a pension fund and one being a non-pension fund, the pension fund will grow about 30% faster purely because it grows tax-free. For proprietary directors, so anybody here who's shareholder and a business owner of a company, owns more than 15% shares, there's huge funding. We'll talk about this in one of the case studies shortly. There's a huge potential to bring money directly from the company balance sheet into an executive pension that's owned by the individual, at the company and the individual, tax-free. So you can bring money from the company directly into an executive pension fund very tax efficiently. But we have to do up a max funding calculation. It takes about a day to do that. We turn that around in a day, and it's us telling the company, actually, here's how much you as a company can pay into the executive's pension tax-free based on past service and current salary and that type of thing. So do contact us if you've any inquiries in relation to that. So investment options for pensions, this goes for group pensions, goes for pre-retirement, post-retirement ARFs, whatever it might be. The first thing to figure out before you dive into building a portfolio for your pension is what your risk is. This will depend on your age profile. So generally, a younger person will have a higher capacity for risk because they have a longer term time horizon. It'll also depend on your personal risk profile. So what is your appetite to risk, your attitude to risk? It'll depend on your other non-pension assets. So somebody with huge savings personally will have a higher risk profile than somebody who doesn't have personal savings. So we have to take that into account as well. And it also depends on what your current view is on markets at a point in time. Simply speaking, more risk means more exposure to risk assets, which are equities and property, and less exposure to low risk assets like cash and government bonds. The different structures for pensions have different investment options. So group structures, so these will be anybody who's got their pension from in a big occupational scheme, so a big multinational, for example, or obviously a government funded scheme. Their investment options will be quite minimal. So generally, if somebody's worked for a big company for years, they may choose to transfer their pension into a buyout bond that's personalized for them to greatly expand the range of investment options, which comes to the next point, which is an individual scheme, but with a life company, it's the most cost-efficient type of pension you can have. It's quite simple and easy to administer and manage. There's no responsibilities on the member. Very, very simple structure. And that's something that we're seeing more and more interest in these days. And then the third type of option is a self-administered pension, which an individual might have with a pensioner trustee or with one of the big stockbroking firms. We can facilitate any of these, so we have no genuine bias over which one. We always recommend what we think is the most appropriate or suitable given a client's needs. We're seeing more and more cost efficiencies with the life company model because of various reasons in terms of how their fee structures work. Self-administered structure can be useful in some cases, but actually because of the way pension rules have gone, I won't bore you with the IORPS 2 directive recently, which is a new directive that's come into Europe, but it's made things like buying properties in a pension very, very difficult. Has to be a maximum of 50% can buy an unregulated product like a business loan or a property purchase within a pension, and that 50% is really actually 30% because a pensioner trustee won't let you put more than 30% in. You can't borrow anymore with the pension, all these different things. So there's a lot happening in that area at the moment. So do talk to us about the structural options for pensions. And it's all about diversification. So we'd always recommend you're diversified in all of these different headings here. You diversify to reduce risk and smooth out your return. So just a reminder, do put questions to me in the Q&A tab. They'll pop up on my screen. No other attendees will see what the questions are. We've got about 7 or 8 minutes for me to go through these 3 case studies, and they will have a few questions at the end. But don't be shy with the questions. So small to medium enterprise owners, business owners, husband and wife, referred into us from an accountant. They're in their early 50s. They're both proprietary directors. In this case, actually, the husband owned all of the shares, but the wife was also working in the business. And even though she wasn't a shareholder, she's deemed to be a shareholder because she's married to the proprietary director as such. So they're both deemed to be proprietary directors for pension fund reasons. They had surplus cash on their balance sheet that they didn't need. They also had this company for a number of years and were receiving a salary for a number of years, so had long years of service. And they had no personal need for the excess cash from the company. So they didn't need to take money from the company through PAYE in excess of what their existing salaries were. So what we did was we created a max funding calculation to say that based on all of the criteria, your ages, your existing pension fund values, your target retirement age, your years of service, your salaries, here's how much the company can put into a pension on your behalf this year and in future years. So there was a huge cash extraction from the company directly into the individual's pension funds, which was obviously a great result. Secondary to that, the investment strategy within the pension is almost like a separate conversation. And no matter what strategy is decided, the investments will grow tax-free because there's no tax on dividends and no tax on growth within a pension. So you can sell assets, no capital gains tax, and receive dividends or rent tax-free as well. The second case study is a couple approaching retirement. So they had a plethora of different pensions from different retirements, and it was a total nuisance to them to have these statements coming in. And actually, one of the things with IORPS 2, the new pension rules, are that anybody who's worked in a company in the past will now have to receive annual statements if it's defined benefit or defined contribution. And that's a good thing. It's going to be a huge headache for pensioner trustees because they have to track down the address of all these members who've left service over the years. But it'll frankly make our job a lot easier because clients will be able to say to us, I know I've got, between me and my husband or my wife, we've got 5 old pension schemes, and actually we're now receiving annual statements, and now we want to consolidate them into one coherent strategy. In this case, this couple, there was no contributions, weren't being maximized to their current schemes. Basically, their pensions were a mess. And they came to us. So the first thing we did was we maximized their contributions. That reduces their net pay because they're maximizing the age-based limits of what can go into a pension. But it means that they're saving tax in the short term and they're building a sustainable retirement fund for the long term. We kept their pension contracts separate, but we moved them all into Compass Private Wealth, so we report on them holistically. And we're using a timing approach, which isn't set in stone, changes every year or two, to retire different pensions at different times. So the most tax efficient thing to do with pensions can be to retire up to 800,000 from age 50. So you get your 200,000 out tax-free, and the 600,000 goes into an ARF, AMRF, and you might actually choose to leave the rest of the pensions until you're potentially 70 or 75 in some cases. And then the other case study is a retired couple. Both had sizable ARFs with investment accounts that were held through a stockbroking firm. They had no consistent strategy. So they had no overall picture saying, I know my pension is vested here and my other pension is here and our investment accounts are invested in these lovely funds or shares. But I want to know the big picture, like what is my overall asset allocation? To us, it's probably the simplest question and it's the easiest for us to solve. We looked under the bonnet and they were paying about 2.5% per annum all in fees. The reason why is because they're paying an annual management fee to a stockbroker of, in this case, it was actually 1% per annum plus VAT, which is 1.23% per annum. And when I first asked them, what are you paying? They asked the stockbroker, what fees are we paying? And they said, oh, you're paying 1%. So they said to me, oh, we're only paying 1%. And I said, no, you're paying 1% plus VAT. And that's actually just a pure consultancy fee. And that actual fee isn't tax deductible for your personal funds. That's a separate thing. But that 1.23%, that's just a consultancy fee. Separate to that, your portfolio is populated with all of these lovely international funds and investment trusts and ETFs and all that. And actually the average weighted total expense ratio of your portfolio is, 0.9%, I think it was. So when you look at your 1.23 plus 0.9, which is 2.13%, and then there was a lot of transactional costs between commissions in some cases and foreign exchange, buying in one currency, selling another, and incidental stamp duties and all these different things. And it meant that they were paying about 2.5% all in per annum for, frankly, a quite poor service. Now, if the target rate of growth is about 3.5% to 4%, you're paying the majority of your returns away in fees. So what we did was we completely rationalized it, reduced our fees by about 1% per annum. You still do have to pay fees. With pensions, you certainly do. There's always QFM or trustee fees. It's kind of unavoidable. But ultimately, we rationalized everything, cleaned up everything, one simple pie chart semi-annual reports with everything, performance, all that type of thing. And for them, it just simplified their life, frankly. So that's it in terms of the overall presentation. We have a couple of questions coming in. The first question here is, well, actually, before I do that, what I'm going to do is I'm going to just show you, like I promised, our website, which has a really good content library. So I'm going to bring up our website here. So just on compassprivatewealth.ie, you'll see that there's a content library section up here. The two areas I've spoken about today are pre-retirement pensions and ARFs. If I just click into the ARFs for a minute, you'll understand how an ARF can be invested, what the imputed distributions are, and ultimately a simple definition of what is an ARF and what is an AMRF. If we go back one page and go into the pre-retirement pensions, which has a lot more sections here, we talk about, personal contribution limits, how much can go in depending on your age, 115,000 earnings ceiling, then employer contributions don't count towards that. One of the questions we have here actually is on the lump sum in retirement. So thanks for that question. I'll actually deal with it here now while I'm in this, if that's okay. So what actually happens when you retire any pension is that the first 200,000 is in a lump sum. Of that, 300,000 is tax-free, and the balance is taxed at 20%. So, for example, a €1 million pension fund retired, 250,000 comes out gross in a lump sum, 200,000 of that is tax-free, and the 50,000 is taxed at 20%. So you'd suffer €10,000 tax on the 250,000 lump sum. And the 75% goes into the ARF, AMRF structure. So each pension fund is dealt with in isolation. So if you worked for company A for 10 years and you left that when you were 45 and you're now 65, we can retire that pension from a buyout bond completely separate and not related to any other pensions that you have. And we, as your advisors, but you as a client or accountants or wherever it is, obviously need to keep a log of any pensions that are retired and what the crystallization value was at that point in time, because that needs to be reported on for all future pension retirements. Just seeing another question here on investments and how much risk one should take. So what I'll do is I'll minimize this. How much risk somebody should take really depends on your own circumstances and what your risk profile is. And your risk profile is dependent on your appetite to risks. That's how much risk you're willing to take, which we figure that out in a risk questionnaire. Also, your capacity for risk. So anybody who says to us, if we talk about non-pensions for a minute, Jonathan, I've got 200 grand to invest, but I need it back. I probably will need it back in a year because I want to give it to my son or daughter because they may need to buy a house. They have a low capacity for risk, even though they might have a high appetite to risk. They have a low capacity for risk because they can't afford for that to drop by 20% because they may need it in 12 months. However, if they said, my eldest kid is 8 years of age, and I want to form a third level education fund of 300 grand for my 4 kids in 10 years time, then they have a high capacity for risk because they've got a 10-year time horizon. So we can afford to increase the risk on that because we have a long-term time horizon. We have more time for short-term volatility to come back. And the third risk metric is tolerance of risk. So appetite to risk, capacity for risk, and tolerance of risk. So you put all of them together. So how much risk can you actually tolerate? So sometimes if certain investments, like we saw with bank shares in 2007, 2008, syndicated leverage property deals, dare I say things like Bitcoin, what they do is they bring in the potential to lose all of your money in one go. And and by the way, I'm not taking a particular view on Bitcoin or any particular shares or syndicated property, but certain investments like a loan note, a venture capital fund, you know the types of ones I'm talking about, where you have the ability to lose all of your investment. So you shouldn't invest in that if your tolerance of risk doesn't facilitate that. But if you go into funds and ETFs and baskets of shares, the type of regulated investments we manage, you're never going to lose the whole amount in one lump. You're never going to get a letter from. We've obviously seen horror stories as recent as this year on certain pension providers losing all the money on overseas property funds and that type of thing. We saw the whole AIB Belfry thing and all that. But if you just exclude them from your portfolio and say, I'm not going to be silly here, I'm only going to invest in regulated funds, so therefore I can have a higher appetite to risk. My tolerance for risk is actually quite high, and my capacity for risk is quite high because of a long-term time horizon. Then you can have a higher risk investment mandate for your portfolio. So that's it. We're 42 minutes, so time has worked out very well. Thank you to all of you for joining us today. My colleagues will send out the slides and the recording later today. And have a nice day, and we'll talk to you all soon. Take care.